Hi, Kevin Retcher, owner of First Meridian Mortgage. Today, I want to talk about the four pillars of home ownership: credit, knowing your debt to income ratios, having a savings plan, and knowing down payment options. Let's get into it. I'm going to try to simplify it as quickly as possible. Credit is your passport to home ownership. Without it, you're just not going to buy a home. Poor credit is going to have a higher interest rate, higher mortgage insurance, and require more down payment. Great credit, less down, lower interest rate, lower MI, more purchasing power. So, understanding your credit is your financial passport, and taking care of it and nurturing it is highly suggested and important. Understanding your credit scores. Credit scores typically range 300 to 850 on a mortgage. Most lenders use this model. Anything at 780 to 850 is the highest category, and it goes down in 20-point increments from there. 780, 760, 740, all the way down to 620 for conventional financing. As long as you get a automated approval on at 620 and above, you're good to go. If you're below 620, you might need to go to FHA, which allows credit scores down to 580. VA loans, if you're eligible, don't have credit score requirements, but below 620 typically is a manual underwrite. Even small mistakes on your credit can impact greatly on your interest rate and what you qualify for. So I highly recommend that you go to annualcreditreport.com. You can get a free credit report there from each of the bureaus throughout the course of the year. So you can get one from each of them, get one every 4 months, check your credit. Second thing I highly recommend is putting your name on the government do not call.gov list. That way, when you do have your credit pulled for a car, credit card, or a home, that they're not selling your information to everyone else that wants to buy your information and solicit you for a similar type of product. Last but not least, optoutprescreen.com. Get on that. Those are the mailers that come to your house saying you've been approved, right? And those are easily stolen out of your mailbox, and your identity can be stolen. Second point on credit: do not co sign for anybody. It's a potential for disaster. I know you love all your family, your brothers and sisters. They ask you to co sign. Honestly, it's not worth it. But if you're going to do it, at least do it this way. Tell them this is the only way I'm going to do it. You're going to make payments to me, and I'm in turn going to make the payments to the individual bank or lender. That way, I can protect my credit. Okay. They just will not let you know because of pride. Hey, I'm falling behind, and I didn't want to bring it up, but I had a late, and you're going to see it that you have a late too, and you're going to find out when you most need it and don't expect it when you're applying for that mortgage, and boom, you got this late last month. Okay, so just don't co-sign for people. It's the best practice. Other factors affecting your credit: 35% payment history. Late payments hurt. Pay your bills on time. Set up auto pay, but double check your auto pay. I've seen more people have lates because they thought it was on auto pay, and the card they were using expired. They were trying to get points, and that didn't payment didn't go out, and now they have a late. Okay, so double check your auto pays. It's not an excuse. Um, the 30% is credit utilization. If you have a $10,000 limit, try not to have a rolling balance over $3,000. If you're at 9,000 on a $10,000 limit, your credit is getting hurt. They use a thing called trending data. So if you had a $3,000 payment last month and you're now at a balance of four and didn't pay it off, that's trending worse. If you had a minimum payment of $250 and you paid 300 or 1,000 and it's trending less, that helps your credit. So try to spread that out over multiple cards, keep your utilization 30% or below, or actively work to pay it down. If you have a high balance and you're just struggling to get ahead, take some side hustle for a little bit and apply all that extra to that card and bring that down, get your credit score up. The other is credit age. 15% is how long the credit's been in existence and being used, the data. They like to see at least 4 lines with 24-month trending data history. If you're someone that's rolling debt over to zero credit card cards and then rolling it to something else, do not close out cards that you've made 12 good payments on. That's good payment history. You close it out, you no longer have it, and you got a card with zero credit history. That will hurt your score. Do not close out debt that you've had for over 24 months on revolving debt prior to wanting to buy a home. Other ways to improve your credit is installment loans. If you get those below 10 payments, it actually doesn't count toward your debt to income ratios, and it helps your scores. Okay, if you can pay that off quicker, go ahead and do that. Other tip is use the snowball effect. If you can pay off a card that you're paying $60 to quicker, then pay that off, but make sure you're applying that $60 to the next card and just snowball and make a bigger snowman. Okay. Last pro tip on credit: keep your inquiries to a minimum 6 to 12 months before you buy a mortgage. When you are shopping, anytime someone pulls your credit, big pro tip: make sure you ask them what your three scores are. If you're shopping for a mortgage and you told me, hey, I just had my credit pulled and I had these three scores, I pretty much am going to trust the data and give you a good quote based upon that data and just tell you, hey, it would need to be confirmed. But you don't need to have multiple credit pulls to get good quotes if you actually know the data. Keep in mind that it is always subject to verification when it comes to that. The other point is if you're shopping for a mortgage and you want to do it all within the same day or two, if you have credit pulls all for mortgages within a 30-day time frame, it should only count as one hard pull. Once you go to the 31st day, then that changes the story. Let's get on to second module, debt to income ratio, knowing how that works. So debt to income ratio, you have two ratios, a front and a back. Front ratio is your housing, PITI, what your payment's actually going to be on the house, including any condo fees, HOA fees, all the fees associated with that, divided by your gross income. So if you have a $3,000 mortgage payment and a $10,000 gross income, that is a 30% front ratio. Back ratio is your front ratio plus all your other debts, car payments, installment loans, credit cards, student loans, added to that, divided by your gross. So if you have a car, a couple credit cards, that's $1,000 a month. Added to the 3,000, that's 4,000 divided by 10. You have a 40 back ratio. Lenders typically like 28% to 36 on that front, and essentially 36 to 50 on the back. But anything over 43 requires typically some compensating factors. So lower debt to income ratio allows you to have lower mortgage insurance. Sometimes it can affect how much money you have to put down for your down payment accordingly, and it definitely affects what you qualify as far as your purchasing power on buying a home. The higher the debt to income ratio, the more purchasing power you're going to have, depending on how much you're actually putting down. So, ways to lower your debt to income ratio: lowering installment loans down below 10 payments because they know that you're probably not going to go out and buy another car, so they don't have to count that toward your debt to income ratio, and it gives you more purchasing power. But keep in mind, if you buy a home, you're still going to have to make the new mortgage payment and that payment for 10 months. So if you can pay it off, pay it off. Okay. The other thing that you can do is potentially refinance car loans, refinance, roll credit cards over to a 0% interest, refinance some of those, potentially bring down your debt to income ratio. The other hack is, of course, renting a room to somebody with some extra cash, apply it towards some of your debt, or getting a second time job for a small period of time to pay down debt. All of those things will help you save money, pay down your debt. Once you have extremely low debt to income ratio, and if you don't have any monthly debt, you should be able to fuel your savings. That's modular 3. Um, Having a savings fund. Highly recommend maxing out your 401ks and IRAs at work, especially if they're doing a company match. A lot of people don't know that you can take out up to $10,000 for a home purchase tax free. And another big tip is, especially for government workers with TSP loans, anything that's already secured by funds that you've already saved, don't count into your debt to income ratio. And if you can take a loan on those, that can be your down payment and down payment plus closing costs potentially. Sometimes I'll have people save up enough money for the down payment, and then they might borrow from themselves for the closing cost. Um, Big thing on savings, budgeting. There's going to be a link in this video. Freddie Mac has a great budget where you put every one of your line items that you spend over a 2-month period and figure out how much you're saving on a monthly basis. How much residual or extra money at the end of all your expenditures is a great place to start. Figure out where you're spending your money. You might be able to tweak your savings by understanding exactly, how many coffees at Starbucks you might be getting. Okay, evaluate those on a 50% needs, 30% wants, and 20% for savings. Those things can help fuel your savings plan in general and help you to get into home ownership quicker. The last pillar or last module is understanding down payments. Down payments are crucial in understanding what you can buy. The more money you have down, the more house you can buy with a lower carry cost, a lower mortgage. So a lot of people feel that you need to have 20% down to actually buy a house. Just not the case. We've been doing 3% loans up to 806 500 through Virginia, Maryland, DC for extremely long period of time. It is income based on county, and so debt to income, credit, all those things come into play, and you can put 3% down in many cases with 620 credit score or greater. Um, Same for FHA, 3.5% down. And if you don't qualify for either one of those, then conventional 5% down. And if you have more money, 10, 15, or 20. If you're extremely lucky and you can do a VA loan at 0% down, and it's the best loan around, doesn't have any county limits, higher debt to income ratios. They actually go by residual income versus those debt to income ratios in general. Okay, there are a lot of other ways to get into properties. If you can save the 3%, the 5%, whatever the case may be, you do still need to have money for closing costs. And there are ways that you and your realtor can work out seller concessions to potentially pay for that. So just because you've just gotten to the point of saving for a down payment, and maybe it took you a little while, and waiting to save up for closing costs is going to take an extended period of time, there are ways to get in sooner by having the seller help you. Okay. And especially on a VA loan, they can actually pay off up to 4% of your debt and give you a 4% seller concession on a VA loan. So there's another video that talks about seller concessions, which I'll also link down below. Okay. There's also what's called down payment assistance programs and forgivable loans that are typically tied to the FHA. If you pay on the loan for 5 years, sometimes they're forgiven. Sometimes they have interest only payments or zero interest. There's a lot of different variety of those programs out there, but they come and go. There's not set programs that are always there. So you may have a county that has some extra funding and they may throw it at a down payment assistant program for a little while. So some of those programs, you just got to keep your ears to the street. Your realtor may know some, your lender may know some, but typically, like the forgivable loans and things of that nature, you typically are starting with a little bit higher interest rate. So, um, if you have high income and low debt to income ratio, those programs may work for you. Side hustles that renting to a roommate, second jobs can help also save for that down payment. Just keep in mind, you do not need to have 20% down to buy a home. So, hopefully, these four pillars will help you get prepared to start your home ownership journey. If you have any questions, give me a call. My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. Uh, Happy to serve. And to all the Marines out there, I say Semper Fi. I'll talk to you soon.